Good morning, children. So here we are continuing with part 3 of the chapter Journal. In the previous part, we have discussed various few transactions, and here we are moving further with it. So let us begin. Here see, as you can see, the serial number 7 till 6 we have already discussed. Now 7th is the opening entry. The opening entry means basically it is a recording of all the assets and liabilities with which the business is started. Till now we have discussed only those entry as of the started business with cash, but sometimes it happens that many a times a business is started not only with cash but also with cash, capital, asset, liability, debtors, creditors, etc. And sometimes the previous year balances of such assets, liabilities, etc. are also brought down in the business from the beginning of an accounting year to the next accounting year. So in such a case, how the entries will be passed? Now you need to remember one thing, children. For this, you need to remember the dual aspect principle. What is dual aspect principle? The dual aspect principle states that every transaction has at least two aspects, as we have discussed, and both the aspect, that is the debit and credit, the two aspects of a transaction, debit and credit, will always be equal. And this is the reason why the debit and credit column, the total of both the columns in case of journal, is always or should be always equal. If it is not equal, that means there is some error, some mistake somewhere. So in case of opening entry, as we know that a business is started with a number of assets, as you can see here, such as land, building, cash, goodwill, prepaid expenses, etc. And also liabilities such as bank loan, capital, etc. So what we need to do is, such assets and liabilities are recorded at the beginning of an accounting year in an entry form which is known as opening entry. So what is an opening entry? Opening entry is basically an entry where the various assets and liabilities with which either the business is started or the accounting year of the business is started is recorded in the books of journal. It is passed to record all the assets and liabilities with which the business is started. There may be the following cases of an entry. Now you should remember one thing, children, that all the debit should be equal to the credit. So there may be a situation when the debit and credit are automatically the same. That means the amount of asset with which the business is started is exactly equal to the amount of liability with which the business is started. Then there can be a second case where the amount of asset with which the business is started is more than the amount of liabilities. And the third case can be when the amount of liabilities with which the business is started is more than the amount of assets. So there can be different cases. Now let us begin how the entries will be passed. You just need to remember one rule for this, children, that all the assets with which the business is started will be debited in the entry, and all the liabilities with which the business is started will be credited in the entry. So as you can see, case A, when the business is started with assets only, that means only the assets have been given to you and no amount of liability is given to you. In this case, all the assets will be debited and a subtotal of all the assets will be credited to capital account. That means if the question says that a business which started with, let's say, land 10,000, building 20,000, furniture 30,000, debtor 40,000, etc. and no amount of liability is given to you. So all the assets will be debited, right? But what about the credit aspect? Something has to be credited also. So in that case, what we will do, the subtotal of the assets will be credited to capital account, because we know what is capital. Capital is the amount invested in the business, and it is a liability, therefore it will carry a credit balance. Case B, when the amount of asset is more then the amount of liability. When both the asset and liability value is given to you children, you will debit all the assets and you will credit all the liabilities. They should be equal. If they are equal, well and good. If they are not equal, let's say if the amount of asset, that is the amount of debit, is more than the amount of liability, that means amount of credit, that means the deficiency lies in the liability, the deficiency lies in the credit aspect. Then in this case what you will do, you will transfer the excess amount of asset over liability, that means the deficient amount, you will transfer it and credit it to capital account. So as you can read here, all the assets will be debited and all the liabilities will be credited. The excess amount of assets over liabilities will be credited to capital account. Third case, just vice versa, when the value of asset is less than the value of liability. Again, if the business is started with various assets and liabilities, all the assets will be debited and all the liabilities will be credited. If the value of liability is more than the asset, that means the deficiency is in the amount of assets, then the deficient amount of liabilities over asset will be debited, will be transferred to goodwill account. As you can read here, when the value of asset is less than the value of liability, all the assets will be debited and all the liabilities will be credited. The excess amount of liabilities over assets will be debited to goodwill account. Now let us discuss few examples to make it more clear. As you can see, example number 1, started business with land 10,000, machinery 20,000, Rehan, who is a debtor, 5,000, livestock 5,000 and cash 50,000. So as you can see, land, machinery, Rehan, a debtor, livestock is basically the animals, and cash, all these are assets and there are no liabilities. So what you will do, you will debit all the assets. That means, as you can see, land account debited 10,000, machinery account debited 20,000, Rehan debited 5,000. We will not suffix the word account in front of Rehan because Rehan is a human being. Livestock account debited 5,000, then cash account debited 50,000. So we have debited all the assets. Now what we will do, the subtotal of this, that means 90,000, will be credited to capital account. So to capital account 90,000, and narration can be for business started with assets and liabilities. So this will be the entry for this case. Next example, started business with cash 10,000, prepaid expense 5,000, plant 10,000, bills receivable 20,000, above a creditor 10,000, outstanding expenses 5,000, bills payable 1,000. So if you see here, the business is started with both with the assets and liabilities. So what we will do is, we will debit all the assets and we will credit all the liabilities. So we have debited cash account debited 50,000, prepaid expense account 5,000, plant account debited 10,000, bills receivable account debited 20,000, and we have also credited all the liabilities to VAB of 10,000. VAB is a creditor, creditor is a liability. Therefore we are crediting it, but we have not suffixed the word account because VAB is a human being. To outstanding expenses 5,000, to bills payable account 1,000. Now after debiting all the assets, the total of asset is coming to 45,000. But after crediting all the liabilities total is coming to 16,000. That means there is a deficiency of 29,000 in the credit aspect. So this balancing figure of 29,000, that is the deficient amount, will be credited to capital account, and the narration can be again for business started with assets and liabilities. The third example, started business with cash rupees 10,000, debtors rupees 5,000, bank balance rupees 5,000, creditors 20,000 and capital 50,000. So what we will do? We will debit all the assets and we will credit all the liabilities. So as we know, cash is an asset. So we have debited, cash account debited 10,000, debtors debited 5,000, bank account debited 5,000. Then these are the assets which is given to you in the question. Then we will credit all the liabilities. 2 creditors 20,000, 2 capital account 50,000. So if we see, the total of asset will come to 20,000, that is 10,000 plus 5,000 plus 5,000. Whereas the total of liabilities will come to 70,000, 20,000 plus 50,000. That means there is a deficiency of 50,000 in the debit aspect, that is the asset aspect. So we will transfer the balancing figure, the deficient amount of 50,000, to a new account, that is goodwill account. So goodwill account as a balancing figure will also be debited with the deficient amount of 50,000. And now the debit and credit will be equal. And the narration can be for business started with assets and liabilities. So these are the 3 cases, children, where no liability is given to you, only the asset balance is given to you with which the business is started. So you will just transfer the sum total of all the assets to capital account. Then second case, when the amount of asset is more than the amount of liability, so you will transfer the deficient amount to capital account. And third case, when the amount of asset is less than the amount of liability, then again you will transfer the deficient amount in the goodwill account. Note: in case of an opening entry, if the total of debit is more than the total of credit, the balance will be transferred to capital account. On the other hand, if the total of credit is more than the debit, the balance will be transferred to goodwill account. So this we have already discussed. I hope these transactions are clear to you, children, especially the cases. Moving ahead, children. Now we have discussed some of the basic transactions. Now we are moving ahead towards some special transactions. So starting with the first special transaction, that is depreciation. That we have already discussed the meaning in the terminology chapter, but still, just for the revision sake, what is depreciation? Depreciation is a reduction in the value of fixed tangible assets due to wear and tear, usage, etc. That means with the passage of time, as we go on using our fixed tangible asset, those assets which cannot be converted into cash within 1 year without any loss, and also which can be seen and touched. So this is the reduction. Now, as you know, with the passage of time, things become obsolete, and obviously the value of such tangible assets go on decreasing with the passage of time. So such decrement in the value is known as depreciation. It is a loss for the business, and therefore as per nominal account, it carries a debit balance. As you can read here, it is the reduction in the value of fixed tangible assets due to wear and tear, damage, usage, time, etc. It is a loss, and being a nominal account, it carries a debit balance. Since it reduces the value of an asset, therefore, asset account is credited. Now, if you remember, while discussing the rules, besides the golden rules, we have also discussed various points to remember, in which we had discussed one point, that all the assets carry a debit balance, and if the value of asset increases, we debit it more, and if the value of asset decreases, we credit it opposite. Therefore, depreciation will be debited because it is a loss, but because of this loss, because of this depreciation, the value of asset is decreasing, and therefore we will credit the asset account. For example, charge depreciation at the rate 10% per annum on machinery. PA stands for per annum, that means per year, on machinery costing 1 lakh. That means you have to charge depreciation at the rate of 10% on machinery, the cost of which is rupees 1 lakh. Now this per annum word is very significant, especially when the date of purchase of asset, machinery, etc. is given. But as of now, in this example, no date, nothing is given. Therefore, we will assume it that the machinery is has been bought at the beginning of the year, and the depreciation will be charged for the entire 12 months, entire year. So the value or the cost of the machinery is 1 lakh, and you have to charge depreciation at the rate of 10%. Now depreciation will be calculated on the value of asset itself. So 10% of 1 lakh will be 10,000. So what will be the entry passed? Depreciation account debited 10,000 in the debit column to machinery account, because with this depreciation the value of machinery is decreasing. So to machinery account 10,000 in the credit column. What can be the narration? For depreciation charged. Next special transaction is bad debts. What is bad debts? It is the amount which could not be recovered from our debtors, maybe because the debtor has become insolvent or bankrupt, etc. So it is kind of a loss, and again, being a nominal account, we know that all losses and expenses are debited, therefore we will debit bad debts account. And what is happening? Because this is the amount which could not be recovered from our debtors, that means debtors is being wiped out from our books. The value of debtors or asset is decreasing, therefore we will credit debtors account. So as you can read here, it is the amount which becomes irrecoverable from the debtors. It is a loss, and being a nominal account, it carries a debit balance. Since it reduces the value of debtors, therefore debtors will be credited. For example, Swati, a debtor, became insolvent and the amount of rupees 2,000 could not be recovered from her. That means Swati is a debtor for 2,000 rupees who became insolvent, and this amount of 2,000 could not be recovered from her. That means this amount of 2,000 is bad debts, and bad debt is a loss. So what will be the entry passed? Bad debts account debited 2,000 to debtor, and the name of the debtor here is Swati. Swati is a human being, so we will not write the word account. So what will be the entry? Bad debts account debited 2,000 to Swati 2,000. And what can be the narration? For amount not recovered from Swati. Moving ahead, bad debts recovered. Now this is something different. Here it means that whenever the bad debts have been recorded in the books, for example, just the previous example which we discussed, for example, I am just telling you verbally that Swati was a debtor for 2,000 who became insolvent, and the amount of 2,000 was written off, wiped out from the account. It was closed, assuming it to be a loss. But it might happen that some time after that, maybe Swati or any other debtor might undergo some other financial project or anything, and might be returning the amount of bad debts which was previously written off. So that is known as bad debts recovered. It is kind of a gain, because we assumed it to be a loss. We had written it off like a loss, but later on it was recovered unexpectedly. That means it is known as a bad debts recovered, kind of a gain. So since it is a gain, again being a nominal account, we know that we credit all incomes and gains. So therefore bad debts recovered account will be credited. And when we receive this amount, cash is coming in the business, and as we know, cash being a real account, debit what comes in, therefore we will debit cash account. So what is bad debts recovered? It is the amount of bad debts recovered which was previously written off. It is a gain, and being a nominal account, it carries a credit balance, and cash or bank account is debited as it increases the cash or bank balance, or also because cash is coming in. So for example, received rupees 5,000 from Shreya, a debtor whose account was previously written off. That means Shreya was once a debtor who might have become insolvent, whose account might have been written off, and now she is returning the amount of 5,000 which was previously written off. So this will be termed as bad debts recovered. Now since this 5,000 is coming in the business, so cash account will be debited 5,000 to, now again since we are receiving the money in cash, we do not have to record the name of Shreya, and also we do not record her name because we have already closed her account. So we will not open it once again. We will simply credit to bad debts recovered account. And what can be the narration for bad debts recovered? Moving ahead, Outstanding expenses. If you remember, while discussing the classification of accounts or types of accounts, we discussed these terms: outstanding, prepaid, pre-received, etc. So outstanding expenses means those expenses which have fallen due but have still not been paid by the business. That means the time has come, it has become due, but the business has not cleared the payment. So it is kind of a liability for the business, and therefore outstanding expense carries a credit balance, and the respective outstanding expense, the respective expense will be debited, because we debit all expenses and losses. So as you can read here, it is the amount of expense due but not paid by the business. It is a personal representative account and is a liability for the business carrying a credit balance. It is also known as accrued expenses. That means outstanding expense is also known as accrued expense. Let us discuss an example to make it more clear. For example, rent payable rupees 1000 per month. Now how much rent is payable? Per month 1000. And an accounting year, how many months are there? 12 months. So if the rent is to be paid as 1000 per month, that means 1000 for 12 months. How much money is to be paid as rent? 1000 into 12, that is 12,000 has to be paid. Actual rent paid 10,000 for the current year. That means how much is the actual rent? Rent was supposed to be paid as 12,000, but actually the rent has been paid as 10,000. That means 2,000 has not been paid as of now. So this 2,000 will be the outstanding rent. So here you can see the entry. First entry we have passed for paying the actual rent of 10,000. What will be the payment entry? As we know that rent is a nominal account, and we have discussed the rule that in case of nominal account, even if the word cash is not there, not given, or no specific information is given, we assume it to be in cash only. So we will, and since rent is an expense, expenses carry a debit balance, so we will debit rent account, and since by paying this expense cash is going out, so we will credit cash account. So what will be the entry? Rent account debited 10,000 to cash account 10,000. What will be the narration? For rent paid. This is the entry for actual rent paid. Now the next entry is for outstanding rent, the rent which has not been paid yet. Again rent account will be debited because it is expense. No doubt it is not paid, but at least it has fallen due. So rent account again will be debited with the outstanding amount, that is 2,000, to outstanding rent account, because this amount has not been paid as of now. It is a liability, and liabilities carry a credit balance for outstanding rent. As you can see in both the entries, one thing is common, that is rent account is debited. In the first entry it is debited with 10,000. In the second entry it is debited with the 2,000. In the first entry cash account is credited. In the second entry outstanding rent account is credited. So since rent account is debited in both the entries, what we can do is we can pass an alternate entry. Instead of passing those two entries, we can pass one entry which is known as compound entry or combined entry. What is a compound or combined entry? In which more than one account is debited or credited, that is known as a compound or combined entry. So what can be the combined entry for this? There we had debited rent account twice, once with 10,000 and once with 2,000. So what we can do in the combined entry, we can debit rent account altogether with 12,000, that is 10,000 plus 2,000. And then whatever is credited to cash account 10,000, to outstanding rent account 2,000. What can be the narration? For rent paid and outstanding rent. So it is up to you. You can pass those two entries separately, or you can pass compound entry like this. It is better if you pass the combined entry. It looks better. Moving ahead with outstanding income. It is just the opposite of outstanding expense. That means outstanding income means those income, the services for which has been rendered. It has become due, but it has yet not been received. Now, since the business has given the service, the income has fallen due, but it has not been received. It is an asset for the business, and therefore outstanding income or accrued income will be debited. It is the amount of income earned but not received by the business. That means the services have been earned, services have been rendered, it has fallen due, but income has not been received. It is a personal representative account and is an asset for the business because services have already been rendered. Now only the payment has to be received, and since it is an asset, therefore it carries a debit balance. It is also known as accrued income. For example, commission receivable 2,000 per month. That means how much commission is to be received by a business? 2,000 per month. And how many months are there in a year? 12 months. So 12 months into 2,000 rupees, that is 24,000. That means how much commission needs to be received in a year? 24,000. Actual commission received rupees 18,000 for the current year. 24,000 was to be received, but the business received only 18,000. That means there is an outstanding commission for rupees 6,000. So what will be the entry? First entry we have passed for actual commission received, that is since cash is coming in, so cash account debited 18,000 to commission account 18,000 because commission is an income for commission received. Second entry we have passed for outstanding commission. So outstanding commission or accrued commission is an asset. Asset carries a debit balance. Therefore, we have debited accrued commission. Accrued commission account debited 6,000 to again the income, respective income, that is to commission account 6,000 for outstanding commission to be received. Now, if you see in both these entries, one thing is common, that commission account is being credited. In the first entry, the commission account is being credited with 18,000. In the second entry, the commission account is being credited with 6,000. So what we can do, either we can pass these two entries separately, or we can pass an alternate entry besides this, other than this, which is known as compound entry or combined entry. And as we have discussed, what is a compound entry or combined entry? An entry where more than one aspect or more than one account is debited or credited. So what we can do here in the combined entry, instead of passing those two entries separately, what we can pass a combined entry. For example, cash account debited 18,000 with the amount of commission actually received. Accrued commission or outstanding commission account debited with the amount of commission which has not been received, that is 6,000. To commission account means 24,000. That is how much commission is actually earned, including the received one and outstanding one. And what can be the narration? For commission received and outstanding commission to be received. Moving ahead towards a new another one special transaction, that is prepaid expenses. Prepaid expenses are those expenses which have been paid in advance. That means it has not been fallen due, but it has been paid in advance. For example, suppose if you pay the fee of fourth quarter at the time of third quarter along with it, then the fee of fourth quarter will be a prepaid expense. So as you can see, it is the amount of expense paid but not due. It is a personal representative account and is an asset for the business carrying a debit balance. It is also known as expenses paid in advance. For example, salary payable to Ram at the rate 5,000 per month. How much salary is to be paid to Ram? 5,000 per month. So in a year there are 12 months. 5,000 into 12, that means a total of 60,000 has to be paid as salary to Ram. He was paid 80,000 during the current year. 60,000 was to be paid as a salary, but 80,000 have been paid. That means 20,000 is prepaid salary, prepaid expense. So this 20,000 which have been paid in advance to Ram, it is an asset for the business, because now this 20,000 further will not be paid once again. It is an asset for the business and therefore it carries a debit balance. So here first entry we will pass for the actual salary paid, whether prepaid or not. Salary account debited 80,000 to cash account 80,000 for salary paid to Ram. Next entry we will pass for recording the prepaid expense. So the entry for prepaid expenses, prepaid expense account debited to expense account. So how much is prepaid? 20,000. 60,000 was to be paid, 80,000 have been paid. That means 20,000 is advance. So prepaid salary account debited 20,000 to salary account 20,000, that is for prepaid salary. Moving ahead, pre-received income. Again it is just the opposite of prepaid expense. Pre-received income means those income which has not been earned, which has not become due but have been received in advance. For example, if the business receives interest for the next year also in the current year itself, then the interest for the next year is a pre-received interest or pre-received income. And always pre-received income is a liability and it will carry a credit balance. So as you can see here, it is the income received but not due. It is also known as unearned income. Pre-received income is also known as unearned income or income received in advance. There are three names: pre-received income, unearned income, or income received in advance. It is a personal representative account and is a liability of the business carrying a credit balance. For example, interest receivable rupees 200 per month. Actual interest received during the year is 3,000. Now, if the interest is to be received as 200 per month, so there are 12 months in a year. As we were discussing, there are 12 months in an year. So if 200 is to be received as interest, 12 months into 200, that means a total of 2,400 has to be received as an interest for the current year. But actually the interest is received 3,000. That means 600 is pre-received interest. So first entry we will pass for actual interest received, including the advance one. That is cash account debited. Cash is coming in 3,000. To interest account 3,000 because interest is an income, as we have already discussed in the part 1 video. Second entry we will record for pre-received interest, that is interest account will be debited so as once it is credited with both the amount advance and actual, and now we will be debiting it with the amount of interest received in advance, so that ultimately the nullified or the net balance of interest account shows you the actual interest for the current year. If we have credited it with 3,000 and now if we debit it with 600, ultimately it will show you a net balance of 2,400 only. That is the current year interest. To pre-received interest account 600, we have credited pre-received interest account because it is a liability for the business because it has been received in advance. And what can be the narration for pre-received interest? So I hope these entries are clear to you, children. Moving ahead to interest on capital. What is a capital? Capital is the amount invested by the proprietor in the business. So whenever the businessman or the proprietor invests certain amount of money in the business as capital, he is entitled to receive a certain amount of interest on such capital for parting with his money, for blocking his money in the business. It is the amount to be paid as an interest on capital invested by the proprietor in the business. This interest is paid by the business to the businessman. Therefore, it is an expense for the proprietor and also it will be debited. On the other hand, it is not paid in cash, rather it is added to the amount of capital. Therefore, we will not credit cash, rather we will credit capital, because when this interest on capital is added to capital, it increases the capital balance, and capital is a liability. So this interest increases the liability, and we know the rule that liability carry a credit balance. Whenever the value of liability increases, it is credited more. It is not paid in cash, rather is added and transferred to the capital account and its balance. It is a nominal account and being an expense, it carries a debit balance. It increases the liability for the business by increasing the balance of capital. Therefore, capital account in this case is credited as we were discussing. For example, capital invested by the proprietor in the business amounted to rupees 50,000 on which interest is to be allowed at the rate 10% per annum. Again, this per annum word is very important when it comes to the date. But here, since the date is not mentioned, so this calculation we will do later on. We will assume that it is calculated for the entire year. So 10% of interest is to be paid on 50,000 capital. So 10% of 50,000 will be 5,000. What will be the entry passed? Interest on capital account debited 5,000 to capital account 5,000. We have debited interest on capital because it is an expense, and we have credited capital account because this interest increases the balance of capital. That means it increases the liability. What can be the narration for interest allowed on capital? Moving ahead, point number 9, interest on drawings. What is drawings? Drawings is the amount of cash, goods, asset, anything withdrawn by the proprietor for his personal use. Now, when the proprietor has invested some amount in the business for business purpose, if he withdraws such amount or a part of such amount for his personal use, he is entitled to pay interest on such withdrawal to the business, and such interest is known as interest on drawings. So interest on capital is paid by the business to the proprietor, but interest on drawings is paid by the proprietor to the business, and therefore it is an income for the business, and therefore it carries a credit balance. As you can see, it is the interest charged on the amount withdrawn by the proprietor for his personal use. It is a nominal account. Being an income or gain, it will carry a credit balance, and drawings in this case will be debited. Example, and why drawings will be debited? Because it will be added to the amount of drawings. For example, proprietor withdrew rupees 1,000 per month for his personal use. If he is withdrawing 1,000 per month for his personal use, there are 12 months in an accounting year. So 1,000 into 12, that means 12,000 is the total drawings. Interest to be charged at the rate of 10% per annum on such drawings. So 10% of 12,000 will be 1,200. That means interest on drawings will be 1,200. So what will be the entry passed? Drawings account debited 1,200 to interest on drawings account 1,200. Drawings account will be debited and interest on drawings account will be credited, because interest on drawings is an income for the, or it is a gain for the business. What can be the narration for interest charged on drawings? The next special transaction is the installation charge. Whenever an asset is purchased, machinery, etc., is purchased by the business for its use, there may be some carriage charges, some labor charges for installing it, etc. There are a number of charges besides the purchase price which are incurred for installing the asset or machinery or plant, or setting up and putting it to working condition. Such charges are known as installation charges, and such expenses are added to the value of asset. These are basically capitalized to the value of asset, and these expenses, rent, repair, everything, carriage, etc., will be added to the value of only those assets which have been purchased first hand, second hand, irrespective. But if such assets are new for business, say any amount which are incurred on an asset purchased for the business to put it at working condition, to bring it at working condition, such charges will be capitalized to the value of asset and are known as installation charges. In addition to the purchase price of an asset, various expenses such as freight, carriage, etc. are incurred to put the assets to use. These expenses for the business but are capitalized and added to the value of asset while purchasing it. In this case, the asset will be debited with the purchase value as well as with the amount of such installation charges. So whenever any asset is being purchased, whether it is first hand, second hand, third hand, doesn't matter, if it is new for the business, so whatever expenses have been incurred right from purchasing it to putting it in the working condition, whatever expenses have been incurred on it, whether it is freight, whether it is carriage, whether it is installation charges, whether it is labor charges, etc., all these value will be added to the purchase price of asset and will be debited to asset account only and not separately. For example, purchased a machinery rupees 50,000, paid rupees 200 for bringing it in the business, paid 800 to a laborer to install it. That means 50,000 is the value of machinery, 200 have been incurred for bringing it, that is kind of carriage, and 800 have been given to the labor for installing it. So that means altogether the machinery actually costed 51,000. 50,000 plus 200 plus 800. So here we will not add labor account or charges account or carriage account. No, all these expenses will be added to the value of machinery itself. So what will be the entry passed? Machinery account will be debited. Why we are debiting machinery account? Because machinery being an asset, being a real account, debit what comes in. Now since the business is purchasing machinery, machinery is coming in the business, therefore machinery account will be debited with the entire amount including the installation charges, that is 51,000. And in case of asset, even if the word cash is not given and unless and until it is specified to be a credit purchase, we assume it to be a cash one. So we will credit to cash account 51,000 because cash being a real account, when we purchase machinery, cash will be paid and will be going out for machinery purchase. So go through the video once again, children. I hope all the transactions discussed by far are clear to you. Go through the videos once again, go through the logics which we have discussed, go through the entries which we have discussed and the examples, so that you can solve further questions. And again, this is a very, very important chapter for your class. This is the assignment based on this part of video, children. You have to answer the following question in your accounts register. You have to solve practical question number 3 and 4 from the chapter Books of Original Entry Journal of your accounts book by D.K. Goel. And do not forget, children, again the same thing which I told you in the part 2 homework or assignment, that while doing the questions, because it is a full-fledged question and we are discussing transaction in point wise, so you will be solving, you will be passing only those entries which we have already discussed, like started business with cash, purchases, sales, returns, expenses paid, income received, then those transactions which we have discussed here, like pre-received income, outstanding expenses, special nature transactions, depreciation, etc. So those transactions which we have discussed so far, you will be solving the entries only on those transactions, and rest of the transactions you can solve as and when we complete the respective transactions. So go through the video once again, children, all the parts in fact, so as to make the concepts more clear. Thank you, children. Take care.